Okay, this is great. So, good morning, everyone. Welcome and thank you for taking the time to join us for today's presentation. If we haven't met before, my name is Barbara Da Fonseca. I'm the firm principal, and hosting this event today with me is Paul McVean, a valued senior member of our team here at BDCA. Paul is a chartered professional accountant, a trust and estate practitioner, as well as a certified financial planner. I'm a chartered professional accountant, a licensed public accountant, and soon to be chartered business valuator. And we look forward to working with our clients, such as yourselves, to minimize tax and, of course, to maximize your wealth. So our goal today is to share as much valuable information as we can with you, but you know where we are to reach us out to do some planning for you after the event. And before we start, there are a few housekeeping matters. Of course, we've got some nice pictures of the family cottage here. A few housekeeping items. So the first one, the webinar is being recorded. It will be available for you on the website in the near future. Your microphones have been muted just to prevent some accidental dogs barking in the background or interruptions like that. And please use the chat function. You can see the picture on the screen here. It's circled there, the chat box, if you have any questions to ask. We will be going through the chat at the end of the presentation to try to address all of your questions, of course, time permitting. And of course, don't be shy. If anything comes up afterwards, you can email us directly. You have our email addresses or the phone numbers, so please don't be shy and reach out to us. Okay, so here we go. Tax planning for vacation properties and including cottages. Don't forget the family cottage. What are the issues surrounding adding someone to title? Should you gift your vacation property to your family during your lifetime? Should the vacation property go into a trust? And what are the issues with rental use of your properties? So the first item we're going to discuss is the principal residence exemption, and can you claim it on a vacation property? Well, the principal residence exemption, what is it? It is an exemption that allows the capital gain to be tax-free to the vendor of a principal residence. Multiple properties may actually qualify as a principal residence. However, currently you can only claim an exemption on one property for a given year. And post 1981, so beginning January 1st, 1982, spouses and common law partners must not claim the exemption on any property other than that which is claimed by the spouse or the common law partner. So essentially one per family, which includes common law partners and children. And the property does not have to be in Canada for it to qualify for your principal residence. Some people think that it also has to be located in Canada or even Ontario for that matter, if that's where you reside most of the time, but no, it does not. So the property does not have to be in Canada. However, this is the capital gain exemption. The principal residence exemption is available to you, the Canadian taxpayer, so you do have to be resident of Canada. So what kind of properties can qualify? And I think that you'll be pleasantly surprised to find out that certain properties can qualify that perhaps you thought did not before. So we have the house, of course, apartment, a duplex, condominium, yes, your cottage, a mobile home, a trailer, a houseboat, and surrounding land. Now, you'll see after surrounding land, we state but with restrictions. So the main reason why there is restrictions is because some people have a significant amount of land, and the CRA has stated, well, we will allow you up to half hectare to qualify as the principal residence exemption, that property. But if you have greater than half a hectare, the CRA will default to believe that that's an excess. You don't need all of that to live. That's an excess amount and it won't be deductible. Now, you and I know that sometimes with certain properties, there are minimum lot size zoning requirements. So that is an example that if you were audited and the CRA said, oh, that's more than half hectare, you cannot claim the excess and you're going to be taxed on the capital gain that's attributable to the remaining hectares. If you're able to prove there's a reason that it was required, such as the minimum lot size zoning, then that will be deductible. Okay, and the exemption will apply. Okay, now a principal residence must be what is called capital property. So that's not business property or income property or rental property. It must be a capital property. And so what does that mean? Well, that means if you're a house flipper, that it's very, very likely that that is going to be viewed, your home is going to be viewed as inventory, and that this is business income that should be fully taxable, and the principal residence exemption would not qualify in that instance. So it must qualify as capital property. And if you use your principal residence to run your business out of it, and let's say the business is just a small portion, but you decide to claim what's called CCA, capital cost allowance, that is the tax term for depreciation. If you decide to depreciate your house for tax purposes, that will disqualify that residence from qualifying for the principal residence exemption. And Paul will get more into these, into the rental use in later slides in the presentation. Now, we've spoken about, it must be capital property. This slide is going to focus on certain factors that the courts have considered to feel that a property is not capital property and that is indeed income property. So here are some of the factors that the courts have considered. You can take a scroll through, but one, of course, is the taxpayer's intention. If it's quite evident that they were never going to use that as a residence for whatever reason, whatever documentation or belief that CRA has, the location of it, the nature of the business. This is an interesting one. Keep that in mind. The nature of the business or profession of the taxpayer. The extent to which borrowed money was used to finance the purchase. The length of time throughout which the real estate was held. So if it's very, very, very short term, it's very possible the CRA will say there's no way this could have qualified as a principal residence. And factors that motivated the sale of the real estate and the number of parties that are on title. If you look at the red italicized sentence at the bottom, this is CRA's view. The more closely a taxpayer's business or occupation is related to real estate transactions, such as builders and real estate agents, the more likely that the CRA will view it as being property held on account of income. Now, they'll look at each case, individually to assess the facts for and against, and it's up to you, the taxpayer, to have that evidence ready in case the CRA asks. Okay, a little bit more on the principal residence exemption. It must be either owned legally, so your name must be entitled on the title, or it must be beneficially used by the taxpayer. So there might be beneficial ownership, which is again something Paul will get into a little deeper in future slides. And it must be mainly used for personal purposes. So if you are generating some income from that residence, if the income producing property is used less than 50% of the time, then the principal residence exemption should be allowed by the CRA. Again, they'll look at all the other facts to support the case. And it also must be ordinarily occupied in the year. Now take note, not just, it just doesn't have to be you that occupies it. It could be your spouse or common law partner. It could be your child. It could even be your former spouse or former common law partner. Again, CRA will look at all the facts, and it does not have to be a significant use as long as it's a principal use. Its principal use is personal. So there's no hard rule that you have to visit or live on that property or in the cottage for 2 months straight every year. A couple of weeks could be sufficient. Okay. Now, one thing we all know with all of our properties, we do upgrades. I'm currently renovating my basement. At the cottage, we do a lot of work. A lot of these properties have been around for a long time, and significant amounts of funds are invested in the property and considered capital improvements. So it's very important to not forget about those additional costs, to keep track of those costs. Of course, the largest one is going to be the original purchase price. Don't forget the legal fees on purchase. Land transfer tax also qualifies in your improvements. Keep your receipts, any backup you have to support these additions and the increased costs that you have incurred for your property, because if the property does not qualify for your principal residence, at least you'll have this to reduce a taxable capital gain. And if you have more than one property, you're going to have to make a choice, which Paul will go through with you. And let's try to reduce those capital gains and keep the backup and increase the cost of your properties. Here's an interesting one. Even if construction is your main business and you assist with some personal labor, it is not considered cost of the property. You can't add it to the ACV of your property. Okay, and as usual, let's keep those receipts for 7 years in case CRA asks to see them. And I'm going to hand this over to Paul now.
Thanks, Barbara, and good morning, everybody. I just wanted to touch on that last point on the last slide about keeping receipts just a little bit further. We see many cases where people pass away owning particularly cottage properties, and they haven't necessarily kept receipts for very long, but they may have owned the property for many, many years. What's important on that last point is to keep the receipts for at least 7 years after the property is sold. Either a deemed disposition if you transfer to, say, a family member, or if the property is actually sold, or if it's deemed sold on death. That's very important that those receipts get held until after the disposition, not after the date of the receipt itself. With everything being electronic these days, it's pretty easy to scan stuff and just hold on to an electronic record, and that is sufficient for CRA's purposes. Okay, that's what I want to say on that point. So moving on. To claim the principal residence exemption in the year of sale, the taxpayer has to report the disposition on their personal tax return and then fill out Form T2091 to report the claim of the principal residence exemption. This rule changed, I think, in 2016. Up until that point, if you were claiming the principal residence exemption entirely so that the property was not subject to any tax, CRA had an administrative position that said you don't actually have to report it anywhere on your tax return. That changed a few years ago now. So even if the property isn't going to cause you tax because you're claiming the exemption, you still need to fill out this form to indicate to CRA that you're actually making the claim for the principal residence exemption. So the formula for how the principal residence exemption works is you take the number of years that you have designated the property as your principal residence that you want to use the exemption on. If you're Canadian, you get to add a +1 to that. And that +1 really accounts for years where you're buying and selling, because you may own more than one property in a given year simply by moving from one address to another. So you take that as your numerator, and then you divide that by the number of years you have owned the property, and then you multiply it by the capital gain that you have otherwise calculated. And the capital gain is calculated as your proceeds of disposition, less your adjusted cost base that Barbara was just speaking about. And you also can subtract expenses of disposition, which typically would be real estate commissions, legal fees, things along those lines. And when we count the number of years, it's just important to understand that the number of years, we count the whole and part years in question. So if you bought a property in 2010, sold it in 2020, while the duration of ownership may be 10 years, you actually owned it in 11 different calendar years. So that's just important to understand how that math works when we crunch the numbers. And as Barbara mentioned previously, when you own multiple properties that qualify as principal residences, which is quite common if you have, say, a home in the GTA and then a vacation property, maybe a cottage up north, maybe a place in the sun in Florida or Arizona or something like that. Well, then you have a choice to make. You need to choose which property you will claim the exemption on in any given year. And when you use up a year of the exemption on one property, it means it's not available to be used on another property. So we end up having to make the decision on which property to claim the exemption, which property to pay tax. Generally, we prefer to claim the principal residence exemption on the property that has the higher gain per year. But there's a few additional considerations. First, if you hold a property in a non-Canadian jurisdiction, so typically for Canadians, that's often looking at a property in the States, could be in Europe, could be in the tropics, could be anywhere. But if you are taxable in that other jurisdiction, claiming the principal residence exemption in Canada might not ultimately be the best choice because you then are not in a position to claim the foreign tax credit if you're paying tax, say, to the IRS on the sale of a property in Florida. We also need to consider the time value of money. If you sell a property today that has a lower gain per year, but you owe the tax now, versus preserving the exemption for a property that you're not going to sell for another 30 years, maybe you'll pay higher tax, but is it better to pay low tax now or high tax later? Well, that's really sort of a financial planning question. It comes down to what you might do with the dollars in the meantime. And we can do some number crunching to help you understand whether it's better to pay some tax today or wait and pay more tax down the road. And if, as long as it's far enough down the road, maybe that makes sense. So I put together a little numerical example to walk through a scenario here. And what we've got is a cottage that's been owned in 15 years from 2008 to 2022. It's now worth $1 million and it cost $350,000. And we're assuming no other property was owned, so there's no other possible principal residence between 2008 and 2014. In 2015, we've purchased a home in the city and it has grown from $1 million that we paid to be worth $1.8 million today. And we've got no immediate plans to sell. The cottage gain per year, we've got a gain of $650,000 in total over 15 years. So that's about a $43,000 per year gain. For the home, we've got an $800,000 gain over 8 years. So we've got $100,000 of gain per year. Next slide. So first option, we can claim the principal residence exemption on the cottage. So we've got a $650,000 capital gain. We can claim the exemption, pay no tax at all today, but we're exposing $800,000 in capital gains on the house so that we know the house will at least be partly taxable when it is sold some point in the future. If the house is ultimately owned for 25 years, then what we have is 8 of the 25 years not being available, the principal residence exemption is not available. So we have 8/25 of the total gain not being sheltered. Note that this is not the same as the gain that actually accrued between 2015 and 2022. There's no point in time calculation that we're concerned about, or no point in time valuation that we're concerned about when we are calculating principal residence exemptions. We are looking at the average gain per year over the life of the property. So at this point, we know that the house has grown by $100,000 a year, but it may appreciate more slowly or quickly in the future. So that number might ultimately change. The second option we have to work with here is we can claim the principal residence exemption on the cottage for the first number of years that we've owned it, from 2008 to 2014. And then we can save the exemption for the house between 2015 and 2022. So if we work through these numbers, we've owned the house for 7 years, or in 7 calendar years. We get to add our +1. So we have 8/15 of the capital gain that we can exempt using the principal residence exemption, leaving the balance to be taxed on the sale of the cottage. But in this case, we are preserving the principal residence exemption in full for the home that has a much higher gain per year. So likely our advice in the case like this would be to preserve the capital gains exemption for the house between 2015 and 2022, and then pay the tax on a portion of the gain that results from selling the cottage today. But it's something that we can discuss further, obviously, on a case-by-case basis to see what ultimately makes sense. Okay, moving on to the next topic here. What are the issues surrounding adding someone on title? Well, we hear this advice being given a fair bit, often by real estate lawyers who are looking to solve a probate issue. In Ontario, there's a $15 per thousand charge for probate in excess of a $50,000 estate. So essentially 1.5% of the value of an estate over $50,000 is a cost when somebody passes away. And a lot of work gets done to try to avoid this. But adding someone on title often can cause more problems than it solves. The biggest issue we have is that a lot of times this gets done without any documentation around the actual intention of the person who has the property in their name to begin with. And sometimes we see this between spouses, but more often we see this between parents and children, where parents are saying, well, I'm going to pass the property on to the next generation anyways, so why not just add their name on title today? Well, the issue that we get is if we don't know the intention, we're stuck with a presumption. And when a title is, when a name is added on title, when it's an adult child, there's a presumption of a resulting trust, meaning that a gift has not actually been made and the property still is in the, beneficial ownership is still retained by the parent. If the property is put in title between spouses or between parents and minor children, there's a presumption of advancement, which means there's an assumption that an actual gift has been made. So what's really important, particularly between parents and non-minor children, is that the parents document whether this is truly a gift that they're making, which has certain tax implications, or if name is being added on title purely for convenience and they're not actually intending on benefiting the individual economically at this point in time. So it's really important to document what the intention is at the time these transactions are occurring. So that way, from our standpoint as those assisting on the tax side, we will then know how to treat the situation, know how to report for tax purposes accordingly. With joint ownership, when you add somebody on title, they may be joint tenants or tenants in common. Joint tenants has the right of survivorship. So what that means is when somebody passes away, the surviving joint tenants just automatically inherit that portion that the deceased owned. Tenants in common means that each individual owner owns their piece outright separately from the others and can pass that piece on to others should they see fit. So with joint ownership, it's important to distinguish whether you are joint tenants with rights of survivorship or if you're tenants in common, and there are different results that come from the two different forms of joint ownership. Some of the potential issues we get with joint ownership. Well, first is control. If parents own a cottage and they add their kids on title, well, now the kids have some say in what goes on in terms of selling the property, financing the property, using the property potentially. So there is a loss of control when you add somebody on title, and that may or may not fit with your intentions. Another big issue is funding. Often with vacation properties, there are costs associated on an ongoing basis. And if multiple family members are using the property, not everyone is necessarily in agreement as to who uses the property, when, and how that gets paid for. Barbara and I have been talking about a few cases as we've built this presentation, and one that came to mind for me was a family that added 2 kids on title to a cottage. One used it about 6 weeks a year. They lived close by, and they used it a fair bit with their family. Second sibling used it maybe 1 or 2 weeks a year. Wasn't that close, couldn't get there that often. But the first sibling thought that they should split all costs 50-50 because they were both co-owners of the property. Well, obviously the second took some issue with that, and that created some dysfunction in the family, let's say. So it's important to consider some of these softer issues as well with respect to who will make decisions around it, how will things get paid for. Another big issue is adding someone on title could cause that property to be exposed to claims against that joint owner. Particularly, we're worried about family law if a marriage breaks down and there's a claim in that regard, or if somebody has professional or commercial or business liability and there's just simply a claim against them. If they are a joint owner of a property, well, that property may be used to help settle claims. And when you add somebody as a joint owner, it may expose future gains to income tax if the principal residence exemption isn't available. So if we have a parent who adds a child on title and they truly intend to make a gift, so they've given up half of that property, if the child has another home that they are planning to use the principal residence exemption on, well, future gains from that point forward on the cottage may be exposed, and that may not be what is best for the family from a tax perspective. Should you gift your vacation property to your family during your lifetime? Well, many of the issues I just spoke about on the last slide hold true in a case like this as well. But we'll talk about some of the tax implications of making a gift. First thing is it creates a deemed disposition at fair market value unless you are gifting property to a spouse or common law partner. So typically what happens is the gifter, which is often a parent adding kids on title or making a gift to kids or grandkids, they create a taxable event because there's a deemed disposition. Question that comes up frequently is, well, how do we know what the fair market value is? The typical answer to that is to get a real estate agent to provide an opinion of value, which is good third-party evidence if CRA ever questions that number. And if that property isn't fully sheltered by the principal residence exemption, there may be a tax bill to pay. We've come up with a situation more than once where a real estate lawyer has told people that there won't be tax on the transfer to a child. What they're referring to is land transfer tax. Land transfer tax is a function of the proceeds paid. And in a gift situation, proceeds paid is actually zero, meaning there is no land transfer tax. But no, land transfer tax is not the same as no income tax. For the recipient of the gift, their adjusted cost base is the fair market value at the time of the gift. So that's an important number going forward if the recipient then owns multiple properties. And I've spoken about this on the last slide as well, but certainly if there is shared use, then we need to consider the implications and really the mechanics of how you make those decisions. And when parents gift anything to children, including vacation properties, we're concerned with the potential loss of capital for an older generation. We want to preserve capital for an older generation ahead of a younger generation, just to make sure there's enough dollars to support retirement costs accordingly. Younger generations tend to have more time to continue earning funds to support themselves. So before any gift is made, we just want to make sure that the gifter is in a position to actually give up that value. Okay, next topic. Should the vacation property go into a trust? So first thing we want to talk about is, what is a trust? I've put a diagram here, and you may have seen us use this diagram when we presented on trusts and estates in the past. But just as a reminder, or for those who have seen it before, A settlor passes property to a trustee or trustees to create a trust, and the trustee then has a job to look after that property for the benefit of the beneficiaries. The beneficiaries are then in a position to receive the economic benefits of the trust property. This is a relationship for legal purposes, but it is an entity for tax purposes. So trusts often need to file their own tax returns, and they're treated as a separate entity. But for legal purposes, really, it's a relationship between the settlor, the trustees, and the beneficiaries. The implications of using a trust to hold properties, that trustees retain control. So trusts can often make sense where families would like multiple members to benefit from the use of the property in the trust, but want to retain control perhaps at the parental level, or have a smaller group of individuals who are making decisions on behalf of a larger group. Putting property in trust will avoid probate, as the trust document will dictate who subsequent owners are. And for planning purposes, we often consider funding the trust in addition to contributing a cottage or vacation property. Because there are a lot of ongoing costs, it might make sense to not only put a cottage in trust, but maybe a fund of a certain amount of dollars that will help pay for expenses and help maintain family harmony. For most situations, there's a fair market value disposition when the cottage is contributed to a trust, unless we're using an alter ego or joint partner trust, which we've spoken about in the past. If the property goes into trust, there is a 21-year rule concern. And that rule says that every 21 years, the trust is deemed to dispose of its capital property at fair market value. So if we have a cottage that goes into a trust and 21 years elapses, then the trust would have a capital gain based on the increase in value of the cottage over that time. And that can become an issue if the trust does not have funds to then pay the resulting tax bill. There's planning that we often use to avoid the 21-year rule, and that's simply to distribute the property to the beneficiaries, because if the beneficiaries are Canadian, then that cottage can roll out of the trust at its cost base, and we can avoid that 21-year issue. If we have non-resident beneficiaries, property transfers out of the trust at fair market value rather than at its cost base. So when setting up a trust to hold a cottage property, you need to be concerned whether the beneficiaries may be non-resident of Canada now or potentially in the future. And trust returns need to be filed in most circumstances. One interesting rule is that the trust can designate a property as its principal residence for 1 or more years, just like individuals can. And the trust needs to file Form T1079 and indicate each individual who is beneficially interested in the trust. That means they're a beneficiary of the trust, and who ordinarily inhabited the housing unit. And the catch with this, though, is that no beneficiary of the trust can designate another property as their principal residence for each year. So if there are, say, 2 children as beneficiaries of a trust, and one of them is ordinarily occupying the cottage, and the other plans to claim the principal residence exemption on their home, if the trust claims the principal residence exemption, then the children are then prevented from claiming it on a different property. So you might catch somebody and make their own principal residence exemption unavailable if you use this. So you need to be careful how you structure and plan holding vacation properties in trust. So rental use, this has come up, I think, particularly in the last few years, where people are looking to be outside of the GTA and spend some time out of the city, often are renting. So for those who own, we have seen an increase in those who are renting out vacation properties, some or all of the time. There's a significant difference if the rental use is less than 50% versus more than 50%. If the rental use is less than 50%, then the principal residence exemption remains available in most cases. If the use of the property is greater than 50%, then the principal residence exemption is not available. If there is rental activity, well, then you need to report it on your personal tax return. And I think one of the big issues is if you use the property personally as well as to earn rental income, what constitutes the rental portion of expenses? What if the days rented plus the days you actually use doesn't add up to 365? Often for vacation properties, there are days during the year where the property is just sitting vacant. Well, you might take the position that it is rental use other than the days you're actually there, because that allows you to claim the greatest portion of expenses on your personal tax return. CRA might take the position that only the days that are actually rented are rental use, and any unoccupied days are personal use. You just didn't decide to use it that day. So there, it can be a question of fact as to what actually can be reported, what constitutes rental activity versus personal activity. And we may also be motivated to claim lots of days being rented for expense purposes, but we might like the reverse if we're thinking about the principal residence exemption. So there can be conflicting goals from a tax perspective. If you are renting out the property and you claim capital cost allowance, well, that can impede your ability to claim the principal residence exemption. And when you sell the property, that capital cost allowance gets added back as fully taxable income, assuming you sold the property for more than its depreciated value. So you might get some tax savings along the way by claiming CCA, but you might pay it all back and then some at the time of a sale. So you've got some decisions around whether or not it makes sense to claim capital cost allowance to reduce your rental income on an annual basis because it creates some longer term implications. From an HST perspective, there's no GST or HST charged on the long-term residential rent, which would be renting for more than 1 month at a time. But if you're renting out a vacation property for 1 month or less, then there would be HST potentially applicable. There's a $30,000 exemption. Basically, if your rental revenue is under $30,000 per year, then you do not have to register. You don't have to collect HST. But if your rental revenue exceeds $30,000 in any 4 consecutive quarters, then you need to register and begin charging and remitting and reporting HST. If a property changes use, meaning it goes from personal use to rental or rental to personal use, there is a deemed disposition at fair market value according to the Income Tax Act. And that may trigger capital gains and recapture of capital cost allowance. However, there are a couple of elections that may apply that can affect this particular rule. 45 sub 2 election is used when personal use goes to income producing or rental use. And 45.3 is the opposite, when you have an income producing property and it changes to personal use. These elections have 2 implications. First, it causes the deemed disposition not to occur. So we don't have to worry about that deemed disposition at fair market value. It also allows the property to qualify as a principal residence for up to 4 additional years while being rented. So this may allow for greater use of the principal residence exemption, because even though you're not ordinarily occupying it, it still can qualify for that principal residence exemption for additional time. The big hitch to those elections is that you cannot ever have claimed capital cost allowance on those properties for those elections to work, for the property still to qualify as a principal residence for those 4 additional years. So great elections to use, but it comes with certain restrictions that you need to be mindful of along the way. So in summary, vacation properties and tax planning, well, there are many financial and non-financial planning considerations. Hopefully we've highlighted a number of them for you today. each circumstance is a little bit different. So it makes sense to get customized advice. Income tax and HST rules need to be considered before decisions are made and actions are taken. It's important to get professional advice on a proactive basis before you decide to do things, so that way we can be in a position to give you our best advice to structure things on a go-forward basis. And with that, I'm going to turn things back over to Barbara.
Okay, thank you very much, Paul. That's great. So as Paul said, there's a lot of things to be considered. I hope that you all have, learned even just a few little things that are valuable to assist. But of course, please do not hesitate to reach out to us with any questions you have. Some key facts, really think about the amount of land that you have. Is it capital property or not? Capital gains rates these days, if it is considered capital property and you have more than one property and you choose to pay the tax, it's 50% of that gain would be taxable. There's been a lot of speculation. Would the government change the rates, increase the rates? Well, they haven't yet. We thought they might last year, but no, they didn't. And yes, just a lot of things to consider. Remember not to take that CCA. It could impede the capital gains exemption for you in the future. And yes, many, many things. And again, this webinar will be available for you in our website in the near future. So I'm now just going to we're going to go to the question and answer period here now. I'll put this up for Paul's and myself, our emails and phone numbers if you'd like to reach out after the presentation. I'm just looking to see in the chat box, there are no questions as yet. So I'm just going to wait and see if anyone has any question that you'd like us to answer. Okay. I'm putting if you could see my chat box right there, you just touch that and a little box will open for you to allow you to ask some questions. Nothing yet. Okay, we'll wait just a few minutes. I think it's very interesting that a mobile home or a trailer could qualify as a principal residence, but it's true if the other items are met as well, of course, being resident in Canada, etc.
Yeah, the other one that always strikes me, Barbara, is boats.
Mm-hmm.
If you live on your boat, it can also qualify.
Yeah.
I think in Canada, we may not have the climate that accommodates that, but
right.
Certainly an option.
Yeah, that's right. So your boat could qualify, right?
I'm not sure my boat is appreciating.
Okay. I know in the States when I studied, I'm a US CPA also, don't practice it, but I know when I was studying for my US CPA, a yacht could qualify, which was very, very interesting. Okay, we have a question here. Any advice for integration of the cottage trust into the estate or any pitfalls to look out for? Question mark, and then blended families.
Yeah, I think obviously when it comes to estate planning, all of this needs to be considered at a high level. We can't just look at a cottage trust as its own standalone item. We need to figure out how it fits into the greater plans that somebody has for their full estate. Mm-hmm. The cottage trust, I think, like any trust, it can sort of carve out certain assets and deal with them differently from the rest of an estate. So it gives us a lot of flexibility, right? The trust is a great tool for having property move differently than other assets. Mm-hmm. But I think we have a lot of the usual estate planning considerations as to who should be entitled, when, how will the rest of the estate potentially balance things out. Often for blended families, the property may exist from a previous marriage, previous relationship, and one of the parents may want that property to go to their kids from a first marriage, let's say. So cottage trust can certainly help accommodate that sort of planning, but but there's lots to consider, and I think it's maybe the best advice is you can't look at this one planning item in isolation from the rest of an estate.
Mhm. Okay. I'm going to ask you, Paul, a question in terms of the real estate appraisals. And, housing prices fluctuate during the year. And, as long as we have a certified real estate individuals qualified to provide that appraisal, have you ever seen, the CRA challenge that? Because let's say in a market like right now, the market's going down. Have you ever seen the CRA challenge them? I have not.
Yeah, personally, I have not had clients be challenged by CRA on values.
Right.
I think we do a good job at
Yeah.
letting clients know they should have something third party in the file, though.
Mhm.
I think what's also important is the valuation is very much a specific point in time. So the fact that the value may be shifting, well, that's an issue, I think, economically, right? In our own situations, if we hold real estate and it's going up or down in value, well, that's a concern. But for tax purposes, there is a specific day that the valuation is valid on, right? That's the day that we're concerned with.
Mhm.
And if the value changes subsequently, so be it. We would just want that third-party evidence of value on that particular date. So if clients are asking realtors to provide an opinion of value, it's not a current number, it's as of this particular date that a tax event occurred, whether the property is deemed disposed of or it's the time somebody passed away. That's the relevant time that we're looking for that value for. I think in theory, CRA can challenge that if they don't like the number that they've heard, if they think that's wrong. But having third-party evidence, I think, goes a long way. And I think third-party evidence also puts you very much in a reasonable range, I would assume, compared to putting your own number on. Where there's tax implications, CRA's big concern is, well, maybe my assessment of fair market value is artificially low because I don't want to pay tax when I gift the property to my children. So third party is really the key. And I think we're on pretty solid ground if we have that.
I really like the election, Paul, and I know Robin's mentioned here the election and how we have to file it with the tax returns, which is, yeah, absolutely, it has to be filed. I really do love that 4-year period that you could literally rent out the whole property and then still have it qualify as a principal residence as long as the election is filed. Which is great. It's filed with your tax return in the year of transition. Now, one thing I want to look into and get back to, I don't know this offhand, I can't recall. I don't know if you do, Paul, whether we can late file that election if someone decides,
Yeah, typically CRA has no problem accepting a late filed 45-2 or 45-3 election, but it is totally at their discretion. So we cannot count on that. There's no legal basis to make them accept it. So in practice, it seems to still work. And often people don't necessarily have the advice up front and only learn about the election subsequently. But it seems to be possible. I just wouldn't want to rely on that. And I think far better that the election is filed at the time and then there's just no question about it being accepted.
Right. Here's a great question from Rosalind. Just to be clear then, if I sold a non-personal capital use property abroad, is it still taxable in Canada?
Yeah, so this may be, say, a rental property in the States or somewhere else in the world. The jurisdiction that the property is in will possibly charge tax on that as well, being a property located in that jurisdiction. But as a Canadian resident, we have an obligation to report our worldwide income, not just from our property within Canada. So if you hold a property that is located somewhere else in the world and it's sold for a gain based on Canadian tax rules, then there is an obligation to report and pay tax to Canada. To the extent you've paid tax to a foreign jurisdiction, though, typically that will reduce what you owe to Canada as well.
Mhm.
So if you owe, let's say, to the States on the sale of your Florida condo, what you've paid to the States will reduce what you owe. And essentially you end up owing the higher of the two jurisdictions, not both of the jurisdictions. So there's a way to avoid double tax, but you're still obligated to report and pay in Canada.
Mhm. Okay, we have another question here from Craig. Our family cottage has been owned for over 50 years. Many improvements have been done over this time, but what is really normal, little to no receipts for much of the work have been kept or located. Physically, you can see the new furnace, deck, elevation, landscaping, etc. And I'm certain Craig has some photos probably of the pre-construction and from many years ago where it looked much different. Can I bump the cost based on estimates to get this work done?
Yeah, so my approach to this, and this comes up frequently, especially for properties that have been in families for many, many years. I would take the approach that we should count the values the best that you can remember. And the more itemized your list, the better. And I think if it's reasonable, that's good. But if CRA says we'll prove your adjusted cost base without receipts, they may simply deny it. If you then decide to fight CRA, you might end up in court, and the court might look at this and say, well, it's reasonable. I can see the changes in the property over the years, and the amounts that you're claiming appear to be reasonable. Therefore, it might be accepted. So I would still take the approach that to the best of your recollection, it makes sense to still add these numbers in. It just becomes a challenge if CRA says, will you now need to prove that number to us? And if they ask that, they may just simply take the approach that if you don't have receipts, they're not going to count it, and then see if you want to fight that battle. So obviously we want to avoid these battles where possible, but I would not hesitate to add in what you can remember about what you paid. The more specifically it's listed, I think the more it appears reasonable to CRA. And even if you don't have receipts, I think the more likely they would be to accept that if it's fairly itemized with years, amounts, things like that. I think you have a much greater chance that they won't quibble with the number. I haven't seen them ask for proof very often, but it's always possible. It's always a potential.
I know with some of our clients, when it comes to time, personal tax time, and there's been a disposition of a property, and when we're planning with them in advance, we have them, document date of purchase, costs, everything. And so we'll have spreadsheets with, multiple properties and the years across the top to figure out, what would be best for them. We calculate the gain per year over the time period of ownership so that it will allow us to figure out the best result for the client. Because remember, you can only claim one property per year. So with multiple properties, which one do you choose? So we end up getting some decent sized spreadsheets with a lot of information to figure out, what's the best result for the client, which is worth to do because you will save thousands and thousands of dollars. So, because we're quite fortunate, right, to inherit these cottages, to be able to afford these other properties. And then we just have to deal with the tax side of things and try to keep them as low as we can. Okay. Does anyone else want to ask a question? I see Natalie there. Natalie's supposed to be on vacation, but she's joining us for the end. Principal residences, that's a vacation, right, Natalie? Oh dear. Okay then, well, we are going to, Natalie, for those of you that have stayed here to the end, Natalie's going to essentially pull some names out of a hat so that we can give out some great prizes, some golf shirts and some other things. And so she will advise who the winners are, and then we'll reach out to you after the presentation to coordinate delivery of that product to you or pick up in our office here. Okay, I'll let you take it over, Natalie. Thank you so much.
Thank you, Barbara. Hope everyone's doing well. So I'm just going to get to the first name. I'm going to put, and first person is Kathy Power.
Oh, wonderful. Okay.
Yay.
Congratulations,
Okay.
Kathy.
And then the next name will be Carolyn McKay.
Oh, wonderful. Great.
And then the next one will be Netta Starnino.
Great. Congratulations.
And then we have Nancy Clemens.
Oh, great.
And then we have Denise Simpson. And there we go. 5 names. I will contact everyone. Thank you.
That's wonderful. Okay. Well, thank you so much. Have a great day, everyone. Please keep in touch. Reach out to us for any questions you have. And yes, enjoy your day and the rest of your summer and your cottages if you have some, your properties and everything. Thank you. Bye-bye.
Bye.
Bye-bye.